right, well, good afternoon, everyone. Thank you so much for joining us. I think we're the last session of the MarketWatch Best New Ideas in Money Festival, so let's end it with an exclamation point, right, guys?
Right.
All right. Yeah, it's been a great 2 days here, so we hope you have enjoyed all of the sessions. So let's get started and talk about how to spot trends using technical analysis. So to kick things off here is our agenda. So first, Tomi, why is technical analysis important for investors?
Well, we think about how you want to buy a stock or sell a stock, whether it goes up and down, but the market is three-dimensional, and we don't spend enough time on when to do something. So to me, the technical analysis kind of gives you an idea of when you can do something, when you buy, when you sell. You might have an idea that you want to sell, but you don't know when. Mm-hmm. And then you see something that tells you when to do it. To me, that's why I think it's so important.
Yeah. Exactly. It can really help you with that timing. Justin, there's price and volume, support and resistance levels. So that is something that we will also be talking about today. We've got moving averages. We'll also touch on relative strength, patterns, and time frames. So, the trend is your friend, right, Justin? So using technical analysis can help you figure out what those trends are. There's some clues that we can uncover from charts.
Yeah, I mean, there's a reason some of these old sayings like stick around, right? Because there's some truth to them. And one of the things that's nice about charts is that you have a visual representation of mass psychology. And just like you can just really very easily see it right
Buyers
there on the
and
chart.
sellers.
Buyers and sellers.
It's telling us
winning?
A story.
Yeah, who's winning too. So again, that's why it's such an important part. And while the fundamental analysis is important too, this, as Tomi said, it really helps with that timing aspect.
Exactly. And, something else to point out is that just because you have a good company with that good story doesn't mean it's going to be a good stock. So do that fundamental work, but check the chart too.
Right, because you want to buy winners.
Yeah.
Right? You don't.
At least I do.
Right.
Exactly. And something that you mentioned, Tomi, when we were prepping for this is that just because, this is exactly, you've got the volume and the price action and the setup, doesn't mean it's a guarantee.
No, the idea is, you want to see how the market is behaving, and you want to learn how the market behaves. You want to watch what it's doing, and it doesn't always work. You think your kid or your spouse is going to act a certain way because they made a certain face, but they don't always do that.
Yeah.
So, but it usually follows a certain way, but it's usually.
Yeah.
Exactly.
Keep that in mind. It's just a clue of what might be happening.
Yeah, not a guarantee, but it can help us increase our odds of success.
Right.
All right, well, Justin, let's talk about interpreting price and volume. So to orient ourselves here, what are we looking at when we look at a chart when it comes to price and volume? Some of the technical clues that we can uncover with those bars here. What are we looking at?
Right, and again, it's this whole interpretation part, and kind of first you have to understand what you're looking at. So just to orient people, and maybe we shouldn't have been closing with this. Maybe we should have been opening with this session, right? But the idea is you've got these blue bars and pink bars. The colors can change depending on what platform you are. But for here, we got blue bars and pink bars. The blue is just telling you, hey, you went up from the previous close, or the pink, you went down from the previous close. And then you've got that volume, which kind of tells you about the level of conviction. When there's high volume, when there's a lot of trading behind something, that's a little bit more meaningful. Just as when I raise my voice, that's a little more emphatic. Same thing, when you see some price action happening with volume behind it, that's really telling you, hey, this is something you want to pay attention to.
Mm-hmm. So speaking of that close and looking at the range for the day, what can we uncover from that, a big bar versus a small bar, and where we get a close in that range?
Well, when you have a bigger bar, that means that the difference between the high and the low of that day or week or whatever time period you're looking at, there was a lot of price discovery. And that a lot of times means that there was uncertainty, that there were people, or maybe there was news coming out that, hey, we need to think about this company differently. We need to revalue this company. So you see that in the earnings all the time. An earnings report comes out and everyone says, hey, this is worth something different now. And that's where gap ups come from, everything like that, because it's, now things have changed here materially, and we have to adjust our thinking.
Mm-hmm, exactly. And so we're talking about high, low, close charts here. We're also going to talk about candles, with Tomi. But before we do that, let's also talk about tight action. So you talked about a wide bar, but what about really tight action? What does that tell us?
Well, a lot of times, and this comes from Bill O'Neill, the founder of Investors Business Daily, one of the things he used to say is, tight action a lot of times, first of all, there's comfort at that price level, but a lot of times that's where some quiet accumulation can happen. There's these institutional investors, they're buying over a long period of time, and sometimes they'll just be like, hey, this is the price I'm comfortable with. Anytime you see someone selling at that price, I want you to pick it up. So there's a lot of that can happen. And so the tight action is something that's important when you see that. It kind of gives you a range of what the personality is right now. And then when you get outside of that range, that's where you're seeing, hey, something is different now. Something different is happening.
Exactly.
But, we should also, you mentioned the closing range.
Yes.
That does kind of a lot of times follow up the next period where you're looking at, okay, you closed high in the range today, that can often lead into strength the next day. Or vice versa, you close down, a lot of times that can lead into some weakness the next day. So it does give you a little directionality of, at the end of the day, who won?
Exactly. All right, well, let's talk about how to be nimble and quick with candlesticks. Tomi, Jack be nimble over here. He's going to school us on what to look at with these candles, because they're a little different than the high-low close bars.
There's a little more detail in it. These were supposedly, a lot of people think they were developed in the 18th century in Japan by a trader, traded rice futures. What they do is they give you a little more description than a line chart or something, because they tell you there's a body where the difference between the open and the close, and then there's these wicks, or you can call them shadows, the intraday high and intraday low relative to the body. And the body, you color it in if the close is below the open. In these charts, I used red for that, but that's very important, because you can get a new high. You can get a stock gap up to a new high and then close below the open, and it's still up on the day, but you get a lot of frustrated traders out there that bought at the open that actually they had a bad day, and you can feel that emotion in this type of charting.
Exactly. So a bigger candle, bigger wick. What does that mean?
Yeah, the big one shows how powerful. Like, that means the winners at the open won all day long. And that's important to see, because that means they kept the strength all day long, and there was no one to fight them. And even if there was someone to fight them, they still overpowered them. And so it is important to see those big things. But it's also important to see them in relative to where it was in a certain range. If you see it at the high or the low, it can be a much different picture.
Right. I think that's so cool how it really is a visual representation of that psychological or behavioral element with traders. Let's zoom in on these charts, because we gotta give everyone a bit better of a look here. So that was the previous chart, but just zoomed in. So let's talk about some of these candle patterns that we see here.
Yeah.
Walk us through this.
Bearish engulfing is like a really good one, because it's at the very high. It happens, when these pop up, they happen at the high, and it's it's like a pantomime, like if you know a Quentin Tarantino reference. They tell you what's going to happen. They leak their
Foreshadowing.
Right. And at the high, the market's supposed to be very strong, right? So the stock makes a high. The next day, it gaps up to a new high, goes even higher, and then all of a sudden there's a pullback. Pullbacks happen all the time, but usually in a very strong market, natural buyers come in. But in a bearish engulfing, natural buyers don't come in. So at the high, there's something wrong. It's telling you something's wrong. And as you can see in the chart there is a pullback. It bounces. It goes back up to where the bearish engulfing was, and sellers jump in. That's where so that bearish engulfing told you there was something wrong up there. So it doesn't mean you see when you have to short it. It just means if you're looking for a place to sell, maybe I start unloading a little bit.
A great signal there. Yeah, I want to talk about these other patterns that we have on here, because it makes sense having the Japanese background here with some of these patterns, Harami, Doji. Talk to us about that a little bit.
The Doji means, in Japanese, it means at the same time. And it's kind of what you were saying about the small range.
Tight closes or tight action.
At the high, it's like equilibrium, supply and demand. The way I see it is like you throw a ball up in the air, and at some point gravity and momentum are equal, and it stops. And that's what a doji is. At the high of a range, it shows you that the market doesn't know what to do anymore. And at the high, they should know what to do. And the fact that they don't know means there's something wrong. And the same with
Another
the
great
Harami.
clue there.
Harami is not a doji. It's not open and close at the same price, but it's inside the previous day's range, which something's kind of funny there. A small body inside the previous day's range at a low, there's something wrong. So the market's just telling you there's something going on, and you should be aware of it.
Yeah, so it's great to be able to pick up on those clues in the charts here. So here's a closer look at that bearish engulfing pattern right at the top there. You wanna
Yeah, it's a
comment
great
more?
chart. Oh, because you could see how
Yeah.
you could feel the emotion. Like it jumps up at after the new high. The stock jumps up and everybody's happy. It rallies up to a big high, the intraday high, and then all of a sudden the bottom falls out, and everybody up there that was all happy are like wondering what happened here.
It's the hangover, right?
Yeah, exactly.
Yeah, and it's like there should be buyers come in. In a strong market, there should be buyers come in, but this shows you there's something wrong there. And then the confirmation is the next day.
Exactly.
Yeah.
And moving on, here's a closer look at that Harami, or island reversal is another name for it.
Yeah, because there's a gap down to a new low, and then there's Harami means pregnant in Japanese, so it's inside the previous day's body. That's why they say it that way. It's because there's something's going on there that people don't know. It's a tight range that Justin was talking about.
Doesn't give you as much of a sense of the direction as something like a bearish engulfing.
Right.
So it's like we need more evidence of direction.
Right, I wouldn't necessarily think that this is a bottoming pattern, except the next day there's a gap up. That means the people that sold in that area are stuck. Anybody that sold down there is now praying that it'll come back to them, and it usually, when you're praying, it usually does.
All right. Well, let's move on here. I got a lot more to get to. I want to talk about the concept of this reverse polarity where resistance then turns into support, Tomi.
Yeah, I love this chart because you could see exactly what people were feeling. This is Amazon, and years ago it was going up, and it just wouldn't go up anymore. And people were selling at a certain level, and there's strong resistance, and then all of a sudden it breaks out in a big jump. So everybody that was selling there is now like, oh no, And then like I was saying, the most religious trader is one who's out of the money, and so when it drops back down to where they sold it, now they're willing to buy right there. Yeah, you can see where there's resistance, and then it breaks down, and then it stops where they were selling it in a few years ago.
Right.
Because they were praying for it to break even, and then once it gets there, then they're like, okay, I'm going to start buying.
Yeah, it's so fascinating because we see this happen over and over again. And not only can you see resistance turn into support and vice versa at price levels, but also moving averages too, Justin.
Yeah.
So let's take a look at that. You can use moving averages for buy signals, but also sell signals. So
Absolutely.
very important to keep that in mind when we're looking at charts.
Yeah, so here's an example with the S&P 500, and you kind of get a sense of the personality of a stock. Certain stocks,
Or an index.
or an
Yeah.
index, right, or an ETF, whatever you're looking at, really, anything that has a price and time, element to it. So what you can see sometimes is that there will be certain instruments that will just kind of follow a pattern. They'll develop a personality. And in this case, for the S&P 500, the personality was it would come down to that 10-week moving average line, get support, and bounce. And it just kept on doing that. Now, once you get used to kind of a personality, you also have to be very aware when that personality changes, because that's telling you something as well. And a lot of times that floor, what was acting as a floor, can all of a sudden become a ceiling. And now you
Right.
start hitting your head in that same way that the reverse polarity that Tomi was talking about.
Yeah, exactly. So looking more recently, we saw some major resistance at a moving average for the S&P 500 here at the 40-week line. That's the black line on the chart here. So another clue that maybe we could see a change in direction there. Also on an individual stock level, you could see for Neurocrine here right around round numbers too also have significance, and with resistance then turning into support, something that we like to look at, double verify DV, another example here showing that. Sorry, as you can tell, I'm trying to pick up the pace here. I'm looking at the clock. A lot to get through here, and Always a fascinating discussion with you guys. Let's also talk about patterns. Okay, so we've got price, we've got volume, and we've got the moving averages. Now, let's take a look at chart patterns. Justin, what do you think?
Well, this is just something that we see happen over and over again historically. You can look at, I mean, I started in the late 90s, and there were a bunch of these internet stocks that had these patterns. But I can show you patterns from 1900 where the railroad stocks looked the same way, because yes, all of our technology is different now, and it's gotten so great over the last 100 years. But our mass psychology, that hasn't changed, and that's what charts are showing you.
People don't change.
Right, people don't change.
Still people.
Yeah. So there's different pattern, cup with handle, flat bases, double bottoms. We talked about tight action. So there are different patterns
Flags,
that you can
pennants,
use.
you know,
Yeah.
Shoulders.
Head and shoulders. So
right.
lots of different patterns that can give you further information, potential buy signals, sell signals, and the like. But Tomi, when it comes to moving averages, let's talk a little bit about what we should be watching for with the moving averages, some additional tips for the audience.
Well, like Justin was saying, depending on the personality of a stock or index, some of the moving averages don't work.
Yeah.
Because this stock doesn't care about it. This crowd that's following this stock doesn't care about it. But sometimes you start to see, when you see that it actually working, and then you see different time frames of moving averages, like the 50-day or the 200-day. Those are the more common ones. And then they start to cross over. They start to get closer together, and then you start to see the sense that, okay, you know the stock's been going down, but this is just a reminder that this isn't necessarily a buy signal or a sell signal, because it's so well telegraphed. But it's a reminder that, yeah, it's been weak for a long time. And you have to remember that when something's weak, it usually stays weak until something changes.
Exactly. So don't rely on a death cross to be your signal to get out. If you're looking at candles and using moving averages as sell signals, maybe that crossover is a little late.
Yeah, but it can also be, right, it could be late, but it could also remind you that, wait, this is a stock that's been going down for a long time. There's a buy signal,
time.
but maybe I don't want to get in yet just yet.
Such a great point. All right, also to help individual investors who want to pick stocks to outperform the market, a way to do that, Justin, is by looking at relative strength. So that measures a stock's price performance versus the S&P 500.
Right. And I want to be clear, because, you know, RSI, the relative strength indicator, is something that a lot of technicians will use. But what I'm talking about here is just relative strength versus the market, or versus, you know, all of the stocks. And so, you know, just using a relative strength line versus the market can tell you, hey, where is my stock stack up? You know, is this something that is outperforming and stronger? And it can very quickly visually tell you, hey, why would I want to be in a stock if it's not outperforming the market? Why not just buy the S&P 500,
Right.
take
Call it
away
a
the
day.
single stock risk, and you know, and then just sit, right? So if you're going to be getting long on something, you really want to have that evidence of outperformance.
And so here's Booking Holdings back in 2009, which did show that relative strength. Like, maybe we'll start to see some stocks look like this. They've taken hard hits. They do have the declining moving average, but if they can get above those levels, maybe form a chart pattern, some bullish price and volume action that might get us interested.
Well, and the leaders are the ones that tend to do it first.
Exactly.
So that was after the financial crisis. The market was making new lows, and Priceline was holding up. It was not making new lows. That was your tell right there.
Yeah, another great tell there. Let's quickly touch on time frames as well, because a lot of the charts that we showed were daily and weekly charts. You can also look at monthly charts, intraday charts. How do we know what time frame we should be focusing on, Tomi?
Well, if you're a long-term trader, then you should be looking at weekly and monthlies and stuff like that. I don't have the stomach for if I'm trading.
Not looking at 1 minute charts
Yeah, I don't
all
have the
day,
stomach
every day.
to wait 3 months for something. My background was something much quicker, so I'll look at a much shorter term chart, because if I see something move and I'm making money, then I get out. If I see, so it depends on your own risk tolerance. Like, are you a long term trader? What is your goal? What are you trying to do with this stock? If then you look at a weekly or a monthly, a daily. Even the trend reversal signals might not last that long, also, but it's just an idea.
Yeah. Also, it seems like know what your trading style is. Once you've determined that, it's still important to consult those different time frames, because something might look really great on a daily chart, but if you go to a weekly or a monthly, you might get a different perspective on it.
So once you identify your time frame, identify the tools that you need. You're not going to come into a job where it requires a lot of cutting with just hammers, right? So again, this is where you just got to pick the right tools.
Right, and reversals, cup with handles, tight action, all of these patterns and signals that we talked about throughout can be seen on these various time frames as well. It's not like you're only going to see a cup with handle on a daily. You can look intraday, you can look monthly, and you might see these different patterns show themselves on those different time frames as well.
Absolutely.
All right, so let's wrap up here, guys, and your final thoughts, why you think that this audience should start incorporating more technical analysis into their routine.
Well, it's just the idea that, the homework is important, and like you said, the fundamentals are, of course, but you have to respect the technicals, because it's a third of I see it as a third of the market. And you don't want to ignore a third of the market, the timing aspect of it, the third dimension, the way I see it. So you have to respect it. And you don't have to focus on it completely, but I think it is something that you do have to respect and spend time on.
And Justin, what about you?
Well, and to that end, I think, by focusing on price and volume, there's a lot of things that you can use, MACDs, oscillators, stochastics, and RSIs.
You can go a little crazy.
Right, yeah, you can go a little crazy, but it really does come down to price and volume. And we talked about some very basics here, and you're kind of stacking these on each other, right? You're seeing moving averages, and then maybe a bearish engulfing pattern, and then this, and then this, and that kind of gives you an expectation. And then when you see that follow up to the expectation, you know you're on the right track. If it breaks that expectation, then you've got to change your thesis. And having that flexibility to do so, I think, is what makes successful traders.
All right, thank you, guys. Do we have any questions from the audience? All right, you, sir? Should we get
indicator, moving average or an exponential moving average for deciding for the short term kind of movement?
Yeah, so he's asking about, for short term, do you prefer the simple moving average or an exponential? The exponential will be a little bit tighter. It'll hug that price a little bit tighter. They're usually pretty close though, but the more points you have, the more of a difference it's going to make. So again, I think it comes down to time frame.
Thank you so much.
I've been shaken out. Can you hear me? I've been shaken out of stock so many times that Amazon, for example, 1999, 2000, whatever it was, and I had it at a basis of like $10, and $10. It was $10, and I had like 1,000 shares at $10, whatever it was, and I got shaken out. I mean, so how do you, with your charts, how do you identify the possibility or just
I think having rules, but having the stop loss rules, right? But the willingness also to get back in if another opportunity presents itself. What do you think, Tom?
Right. It's not. You have to remember, it's not an all or nothing thing. You don't have to buy and then sell. You can buy, then when you see a little negative pattern, you sell a little bit. And if it goes back up, then you reverse that trade, and then so you get back to where you were. If it goes higher, you still have the same position. It might be at a lower point, but you're still in the money. So it's okay to buy above where you sold it. So it's okay, you can take some profit, take 10%, 20%. You see these things, you layer into stuff. It's the same with buying.
Incremental decisions.
You don't need to make one big buy, one big sell.
But a lot of things use it as a learning experience, right? When you have one of those, take a look back and say, why did I get shaken out? What was it that I missed?
Yeah. Where did I get in? Where did I get out? Why?
The post-analysis and figuring out how can I do better next time, that's how you can incrementally improve.
Fantastic. All right. Well, thank you all so much for joining us for this session on trend spotting at the MarketWatch Best New Ideas in Money Festival. Thank you, Tomi and Justin.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.